following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option, the program aimed at busy financial advisors and asset managers who want to know more about how to implement options into their clients' accounts and into their general practices. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to refer to here as the Options Insider Radio Network, the ever-expanding Options Insider Radio Network, upon which you can also find another great program from our friends over at the Options Industry Council, the wide world of options. I encourage you to go over there and check it out if you're interested in learning more, taking a more broad view, shall we say, at the world of options, a little bit of history, a little bit of analysis, some education, and a smattering of book reviews and tools and all kinds of other great stuff. Joe really throws the kitchen sink at you over there, so check it out. You can find it on our site or on iTunes or anywhere you find your favorite podcasts of choice. And of course, I am joined today on the program by my usual rogues gallery of co-hosts. Starting off, let's go in order of proximity this time. Starting off, the guy who's closest, beaming in from right down the street. You know him, you love him. He is the options major domo over there at RCM Asset Management, none other than Mr. Mike Cavanaugh. Mike, welcome back to the show, sir.
It is great to be back. The month of August here in Chicago has been like no other month on record. There's been no humidity. It's been 80 degrees. So I'm not at the pool today, but I miss it. I've been spending a lot of time there. So checking back in as we start to fall into the more chilly months of October and September and November. So happy to be here and ready to talk some options.
I can tell by that George Hamilton tan you have going that you've been really spending some quality time at the pool, sir.
It's real. It's not a fake bake. It's a real tan.
Speaking of George Hamilton, I'm trying to think what's closer, Durango or Connecticut. I'll have to go with favor of Connecticut, my old stomping grounds. And beaming in from the Nutmeg State, another fellow who enjoys his time at the pool. He is Eric Kott, the director of the Advisor Initiative over there at the Options Industry Council. Eric, welcome back to the show, sir.
Mark, always great to be back, especially with Randy and Mike. And unfortunately, I have not been away as often, but trying to find some time, and we'll hopefully get out next week around Labor Day. But appreciate the mention of Joe in the wide world of options. The program has received a tremendous amount of downloads under iTunes, and he will continue to add new programs on there, so we're excited about that.
Yeah, it's been doing quite well. The iTunes folks picking it up for some new and noteworthy status even, so that's always nice when we see our new programs getting some love out there across the board. And last but certainly not least, beaming in from the farthest and hopefully this time some fire-free area of Durango, Colorado, he is Randy Swan, the founder of Swan Wealth Advisors. Randy, welcome back to the show, sir.
Thank you very much, Mark. It's good to be back, and fall is, at least in the mountains, is coming soon, and that only means one thing: football season is near.
And hopefully the fire season has passed you by now and there's no more raging wildfires out there in Durango?
Nope, not right now. We've had some moisture. We usually get some monsoons in late July or early August, so I think everything is good right now.
All right, listeners, and with the team assembled, we shall dive right into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and those somewhat sad horns mean that it's time for our Options 101 segment. And when preparing for this segment today, we looked back at the full gamut of episodes, the full archive of the Advisor's Option, to see all the myriad things we have covered over the year plus of this show now. And one thing stuck out at me as we looked at the different shows. You know, we've hit on married puts and covered calls. We've hit on the collar, the holy grail of the advisor option positions. We hit on a variety of other things, touched on volatility, touched on a variety of things, the basics, the Greeks, all those things. But then as I looked over the full archive of shows, I realized we've only really touched upon spreads. We did one episode back in January, and we did the basic vertical spread. A very important spread, to be sure, but there is an entire world out there of spreads to really be explored in depth. So we're going to do that a little bit more today. We're going to dive deeper into the world of spreads. Let's start off a quick refresher. If you haven't listened to our episode in January, I encourage you, pause this episode, go download it from our site, find it in iTunes or Stitcher, wherever you find your podcasts, and listen to it there, because that will give you a nice refresher, a nice primer on what we're going to talk about today. I'll give you a quick rundown of what we hit on back in January. We talked on the value of a vertical spread versus a simple buying a call outright. You know, that's one of pretty much everyone's favorite starting options position. A lot of advisors fall into this category as well. They start learning about options, they go out and they buy a call in lieu of buying the stock. Usually it's some out-of-the-money call. We've hit on many times on the show why that is not exactly the best trade. The vertical spread takes some of what we talked about in our earlier episodes, all those things about the Greeks, you know, delta, gamma, theta, vega, and really maximizes them much more in that same bullish position, allows you to reduce your premium outlay, allows you to maximize your theta and all the other things that go into a trade, and also increase your payoff probability. So it's a much better trade overall than just loading up on an outright out-of-the-money call. So vertical spread's a great spread, but a lot of you out there probably heard of some other spreads floating around, and there are a lot of popular spreads that a lot of sites beat the drum about. You may see on TV or read about in newsletters. There's a variety of them. A lot of people keep coming back to the category I will lump together as essentially the spreads with wings category. And there are a couple in there that I think a lot of you have probably heard of and are probably curious about. We're going to start off with a very popular beginner level type spread, and that is the butterfly. And now a lot of you have probably heard about this. We'll get into some of the other spreads with wings in a minute, but the butterfly, a very interesting spread, a very interesting trade, and one that I think is useful for a lot of advisors who are starting to dip their toe into the options waters and starting to realize that just buying a simple call or even a vertical sometimes is not exactly ideal for their needs. So in comes this multi-leg spread. This is a three-legged spread with actually four options involved. That is sometimes a little bit more suitable to their needs. Now, Mr. Kavanaugh, I know you guys love the wheel and a lot of other spreads over there at RCM, but I know you actually happen to like a butterfly every now and then as well. So why don't you take our listeners through the spread known as the butterfly?
Yeah, and I'll talk about the butterfly from a couple of aspects. Their butterfly can be used most, any option spread can be used in two different ways. The two ways that you can use a butterfly are to hedge risk, or to speculate as to profit potential. So I've seen people use butterflies in different capacities. We'll use them from time to time to hedge risk on a credit spread. So if you're short a call, long a call, a call credit spread, you can buy butterflies in front or around if you're starting to have gamma risk. So maybe before I get into the different applications and uses of the butterfly, it'll be good to describe what it is. It's a long, short, 2x long strategy. So let's look at XYZ stock, the world famous XYZ stock. Let's say XYZ is trading at 50, and you want to speculate that the stock is going to go up to, let's say 65, and you have an inkling that you don't want to spend a ton of money, but you want to try to hit a target of the trade to say, I think the stock is going to go from 50 to 65. So you could buy a 60 call, sell 265 calls, and buy a 70 call. So it's a combination of, in this case, a long bull call spread, the 60-65, where you're long one 60 call and short 165 call, adjoined or conjoined with a short call spread, a bear call spread, where you're short the 65 call and long the 70 call. So it would be a 60, 65, 70, 1 by 2 by 1. This would be, in my experiences, every time you do a trade like this, in that capacity, it would be a debit, meaning you would pay a net out-of-pocket expense for the premium that you're purchasing, and the highest amount of profitability you could have would be at the short strike, in this case 65. So you would want the actual expiration, the third Friday of the month, to go off at where your short strike is, so you collect all the premium from the two calls that you're short. The one that you're long above expires worthless, so you lose that money. And the one that expires in the money, the 65, you collect the full premium on. So the actual profitability is the net of the premium paid versus what it's worth at the 70 strike. Now, in my 18 years of trading across different markets, I've only seen somebody pin a strike twice with a butterfly, but I've seen people make profitable trades with butterflies where you don't get greedy. The one thing that people misunderstand about butterflies is the volatility component of butterflies. And I always use the big wheel on The Price is Right to explain what the volatility impact is. Volatility actually makes a butterfly cheaper because it's harder to guess where it's going to land, where the underlying is going to land at expiration when the volatility is spinning so fast. So if you imagine a guy like Eric Cott, who's very svelte, gets up to The Price is Right, and Bob Barker says spin the wheel, or Drew Carey or whoever it is now in The Price is Right, and Eric just rips the thing, it almost comes out of the wall, you're not really going to have a chance of guessing where it's going to stop when it's going so fast. So essentially, you wouldn't place a large bet, or you wouldn't spend a lot of money on premium to guess where that wheel is going to stop, or in this case, where the butterfly is actually going to stop. Now, if a guy like me gets up to the wheel, feeble and weak, and I give it a spin and it only moves 2 blocks, the volatility is very low on the spin. We have a pretty good understanding of where the outcome is going to be. So that butterfly is going to be more expensive because we have a better idea of where it's going to land. So that's the one confusing thing that I like to point out to people when they're thinking of butterfly spreads. Most of the time in a spread you think, I want to be long volatility, long volatility. You want to buy butterflies when the volatility is high, which is counterintuitive because we've been taught that all you ever want to do when you're buying spreads or buying options in general is you want to buy low volatility. This is the one exception to that rule, that you're looking for high volatility, and then what you'd want to see is the volatility gets sucked out of this spread, and then the value will go up if it's close to your targets. So there, I've incorporated an American institution game show into the explanation of a butterfly spread. So I hope that helps.
Hey, Mike, I was going to ask you also, because you made a good point about American style versus European style, but typically for an advisor as well as just a normal investor, looking at a butterfly, they're kind of anticipating sort of a minimal movement, right? I mean, things are, they're sort of looking at this where, things are not going to be, particularly in a specific equity, there's not going to be a lot of movement. Maybe things have been stagnant for a little while.
No, it's a great point, Eric. In all of my years, there's never been a case where I can say the better or the best. It's always what your sentiments are, how you weigh out your sentiments. And if your sentiment is, I don't think this market's going to move very far, and you tend to get closer to the underlying strike price, your butterfly is just going to be a little bit more expensive from a strike price proximity than if you go way out of the money, because there's a less chance it goes that far. So it all depends on how, in this case, the advisor, or maybe it's the client that is relaying his sentiment or her sentiment to the advisor about what the best use of a butterfly is. It's a cheap speculative tool, and it's also a great way to put on targets. But the pros use the butterfly as a pure speculative gauge of the volatility. It's a cheap way to hedge volatility as well.
The way I like to couch butterflies for, newcomers to options, and for some advisors who may be curious about why I would do this crazy, 4-strike trade, is, I think of it this way. Think of it as you're bullish, and we talked before about verticals. A lot of people like to take verticals because they, of course, reduce the initial outlay of the trade. People then become a little bit more advanced. They start to experiment with ratios. So instead of maybe doing a 1-by-1 vertical, they now do it 1-by-2 because they want to reduce their premium outlay. It's a very attractive proposition. It makes that trade much cheaper. Of course, when you think about it, you're 1-by-2. That means you're short an extra call to the upside. So then, of course, the risk of that spread is that the underlying explodes north and it blows through that short strike, and now you have a naked short call. So I like to express to people sometimes the way to think of it as this kind of a call butterfly in this sense, or you can do the put fly, same thing, is really it's a ratio vertical with just a cap on the upside. So you're kind of you're hedging yourself to the upside. So in case the worst comes to pass, in case the underlying really breaks through your strike, you have some protection to the upside. So you're not simply short that ratio, that net short call. So I think that sometimes helps people approach butterflies in a little bit more simplistic manner, because a lot of people can wrap their heads around ratios and the value and when you'd want to use those, and they can intuitively think that they want to buy this ratio spread so that the underlying moves straight to that short strike and sits there. But if it doesn't happen, and it, like you said, Mike, that rarely ever comes to pass where it just sits right at that short strike, then you have this upside kicker, this upside hedge that really tends to protect you in case the worst comes to pass. So butterfly, it's a ratio spread with some protection. That's a good way, I think, to think about it. So if you're an advisor who's looking at starting to get into verticals and is starting to dip your toes into ratios, then the butterfly may be one for you if you're really concerned about some dramatic upside movement. Perhaps you're doing these verticals into earnings, something like that, a period where you really don't want to have some naked short legs hanging around to place. A butterfly may be a good trade for you. Of course, we talked about call flies, but you can do it the exact same thing on a put side of the spectrum. Start that again. Of course, we talked about call flies, but you can do the exact same thing on the put side of the spectrum as well. You can do 1-by-2-by-1 on the put side and make it a put fly. It's the exact same analysis, the exact same reasons to do it, except you're looking at a bearish trade as opposed to a bullish trade. Of course, you can do it the other way around. You could sell the 1, buy the 2, sell the 1. That's a different trade. You want that to move a little bit more. You want that to move toward the wings as opposed to settle right at the short strike. So there's a lot of things you can do with butterflies. We don't want to overwhelm you just with butterflies. We have some other spreads to get to as well. But that's an interesting trade to start thinking about if you're starting to think about vertical spreads. All right, let's move on to our next spread with wings. This is a popular one that I think a lot of you out there probably have seen. I mean, it seems to be, over the last 3 or 4 years, really has become the trade du jour in the option space. There's newsletters, there's sites devoted to it. People just love talking about this trade. People love this this strategy. It's really become one of the most popular option strategies out there for a variety of newsletters and websites and other services like that. It is, of course, the Iron Condor. I maintain to this day that one of the reasons this trade has become so popular is because the name is sexy. Iron Condor, it sounds like some sort of crazy strategic device, some sort of really dangerous spread that really just kind of draws the eye and inflames the imagination. So, Mr. Randy, all the way from Durango, Colorado, why don't you take our listeners through the strategy, that very, very sexy, very popular strategy known as the Iron Condor?
Thanks, Mark. In basic terms, an Iron Condor is selling two out-of-the-money options, one call and one put, and buying some wings or buying an additional call and put out of the money that are further out than your short strikes. So what you're trying to do when you invest in an Iron Condor is you're trying to have the time decay on the closer options decay at a quicker rate than the further out options, thus generating a profit. That's the basic component of a strategy. Just like the butterfly, it's a four-leg spread. It allows, typically if you go very far out in the market, it allows you to have a very large profit range. The profit range on an Iron Condor should not be nearly as much potential as a butterfly because you're going so far out. The probability of the market move into one of those extremes may be much lower than doing an at-the-money butterfly that you're really maybe a decent sized move would take you to your short strikes on that. So I think that's the main concept of an Iron Condor, and why I think so many people like that trade is because it gives them a very high probability of profit. Of course, the downside to an Iron Condor from my perspective is that when the market does make those big moves, and typically an Iron Condor to me is a leverage trade where you're going to be doing a lot of contracts, you do have a lot of volatility exposure. And so when you get that, maybe that 2+ standard deviation move or higher, that's when an Iron Condor is going to get in trouble. And so that's why I think you need to have, pretty strict adjustment rules and when you're going to make adjustments in those.
Do you guys ever implement a lot of Iron Condors out there? I know you guys are mostly in the overlay with the puts and put spreads and some call writing. I can't imagine Iron Condors factor into that very frequently.
Not at all. In fact, what we do is we're doing strangles, which I guess would be similar, except for you're not buying the wings. And I think the differentiation for us is obviously we're doing it in proportion to our long stock or long ETFs and long put options. So we're doing it in a ratio that's 1-to-1 in terms of the size of the trade, and then our strategy actually uses a lot of butterflies. So we like the butterfly versus the Iron Condor because it's the risk reward is much more in line with what we try to do on an investment portfolio as opposed to a spec trade where you're taking a certain amount of risk capital. So for that reason, like I said, the butterflies are what we use versus the Iron Condors.
Mark, I was gonna say about Randy and Michael, which I think is also relative to the advisor mentality, that when you're talking about iron flies, and I'm not talking about the the 1960s band on the iron butterfly side, but more importantly, utilizing a neutral strategy that for advisors that are looking at this, and you really hit the nail on the head, Mark, is that as they start to get into more advanced strategies, that's where some third-party managers like Swan or with Mike at RCM, where they can actually do a little bit of the guidance, because sometimes for an advisor it's a little bit intimidating when you start to put on a multi-leg trade. And so I think for some advisors who might not have the wherewithal, or they might have some restrictions at their firms to be able to implement these type of useful strategies, that's where individuals like Randy and Mike, I think are really useful.
And the Iron Condor, there's a couple of different ways I think people could approach it and make it a little bit more intuitive for themselves. Like Randy mentioned, the strangle, you can think of an Iron Condor as simply, if you're buying the Iron Condor, you're buying a strangle, which is, of course, you'll remember, an out-of-the-money call and an out-of-the-money put. So that's a position where you want the underlying to move aggressively in order for that position to pay off. And now, when the Iron Condor, you bought this out-of-the-money strangle, but then you're selling a further out-of-the-money strangle, or you're selling a farther out-of-the-money call and a farther out-of-the-money put. to help offset some of that premium and make that trade a little bit cheaper and make that trade a little bit more manageable from a premium and risk perspective. Of course, it seems like a lot of people who get attracted to the iron condor really come to it from the other side of the equation, the short side. That seems to be where most of the newsletters, most of the strategy services and guides and what have you really seem to love the short iron condor, and that is we're taking that trade and flipping it on its head. Now we're shorting that out of the money strangle and then buying a much farther out of the money strangle. You can think of it that way, or also maybe think of it as an out of the money call spread and an out of the money put spread, whichever way really floats your boat and makes it easier to wrap your head around this type of strategy. But you can imagine in the short iron condor, you're doing the opposite. You're selling that nearer to the at the money strangle and then buying the farther out of the money strangle just in case the worst comes to pass and the underlying really moves. And so what you have is a position that makes a profit when the underlying stays between that innermost strangle that you sold, the guts there. So you want the underlying to pretty much stay put. As you do with a lot of these short trades, you want the underlying not to move, and in case the worst comes to pass, you have those out-of-the-money kickers to protect you. And a lot of people like the iron condor because it is a very defined risk trade for the most part. If you sell a $5 iron condor for, let's say, $4.50, you know you have 50 cents of risk in that trade. That $5 iron condor can never be worth more than $5. So that's attractive to a lot of people because they know going into it exactly what their risk is. That doesn't mean there aren't a lot of adjustments that need to go into that trade to really execute and take them off effectively and really maximize the profit potential of those trades. But that defined risk type of trade is really attractive to a lot of people. And again, it's one of the reasons why iron condors have become this very, very sexy trade that has captured the imagination of particularly a lot of high-end retail out there, and certainly a lot of financial advisors as well. But it does require a little bit more options wherewithal, which is why we wanted to discuss it on today's show and at least give you a bit of a primer on how that trade works. Of course, if you want to learn more about the iron condor or any of the trades we're talking about today, you can always surf on over to theoptionsinsider.com, or of course head on over to optionseducation.org. Our friends over there at the OIC have a lot of great educational material on all this stuff we're hitting on today. And before we close up the Options 101 segment, we'll close out, I think, on my personal favorite spread with wings, and that is taking a spread we talked about earlier and mixing it up a little bit. We're going to take the old butterfly and turn it into an iron butterfly. And like Eric joked, this is not the band from the 70s, even though they had that one great song. But this is indeed an option spread, and it takes what we learned about the butterfly and what we learned about the iron condor and kind of combines them into one super spread, I suppose you can call it. Some people like to joke that the iron condor is an iron butterfly for cowards. I like that one, and that kind of holds true when you see what we're talking about here. Instead of the iron condor, let's say you're shorting the iron condor. Instead of shorting that strangle and then buying a farther out of the money strangle to hedge it, you're moving that trade much closer to the at the money strike. So instead of shorting the out of the money strangle, you are now shorting an at the money straddle in the iron butterfly. And then to hedge it, you are buying an out of the money strangle to hedge that trade. So as you can see, because you're moving that trade closer to the at the money strike, you're collecting a lot more premium to sell that, and you flip that on its head. If you're buying the iron butterfly, it's going to cost you a lot more to buy that at the money strike versus the out of the money strangle of the iron condor. Another reason why the iron condor is more attractive, it's a cheaper trade overall. Whereas the iron butterfly, it's at the money strangle, it's the at the money straddle, so it's going to move, it's going to be very expensive, and you're hedging it with an out of the money strangle. So this is a trade where you really want some movement if you're going to be long. And also, flipping it on its head, if you're taking the short side of the iron butterfly, it's a little bit more dangerous type trade because you're shorting that at the money straddle, so any direction the underlying moves, you don't have that cushion that the iron condor gives you. The iron condor, because it's an out-of-the-money strangle to start with, you have a little bit of wiggle room. The underlying can move a little bit before it hits one of your strikes. With the iron butterfly, you're shorting that straddle. So once it starts moving, that's it. So it's a much more dangerous type of spread, much more premium-intensive type of spread usually. It can be very attractive for premium sellers in the right scenarios, and of course, if you're a premium buyer, it could be an attractive spread as well, given the right scenario. But it's also a sometimes more, shall we say, dangerous spread overall, and that's why some people tend to steer towards the iron condor because it's just a little bit easier, gives you a little bit more cushion, particularly if you're on the premium selling side of the fence. You like a little bit more of that cushion versus the iron butterfly, which is, again, you're selling the at-the-money straddle, so you're having a much higher probability of something happening, and that decay is coming out a lot faster on the at-the-money straddle. But the strangle, for a lot of people, gives them a little bit wiggle room, and that's why they like it. So let's sum up here really quick. We talked about the butterfly. It is simply, let's think about it in the call butterfly sense, 1 by 2 by 1, so you're buying that simple vertical spread. You're adding a second leg of selling the call on the butterfly, so now you have a vertical spread, turns into a ratio, and then to protect that ratio call spread, you buy the out-of-the-money kicker, the out-of-the-money hedge. That is your simple call fly. We moved on to the iron condor, which is, of course, an out-of-the-money strangle protected by yet another out-of-the-money strangle. So if you're buying it, you're going to sell the wings, and that will protect you. Vice versa, if you're selling it, you're selling the out-of-the-money strangle and buying a farther out-of-the-money strangle to protect you in case the worst comes to pass. And for those who are not faint of heart, for those who really want a lot of movement, a lot of bang for their buck, whether they're selling or buying, there is the iron butterfly, which takes the iron condor and squeezes it down to the at-the-money strike. So you're going to get a lot more movement, a lot more risk. That could be attractive for premium sellers or premium buyers, but you really need to know what you're doing with the iron fly. And of course, you hedge that long or short at-the-money straddle with an out-of-the-money strangle, again, an out-of-the-money call and an out-of-the-money put, to hedge you against the worst coming to pass and against a dramatic movement in the underlying. So there you have it. 3 spreads with wings that you, the busy advisor, could take and learn and put into your own trading arsenal on behalf of your clients. And I think it will definitely improve your understanding of the options market and allow you to offer more value to your clients. And now it's time to keep on rolling right on into our listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the listener mail segment. This is, of course, the portion of the show where you, the listener, get to take the reins. And we're going to kick things off with a question here from Tom S. He writes, how do dividends impact option prices? Let's say my clients own a put on a stock and it declares a substantial dividend. Do they collect all the profit from the stock drop in the price of the put, or is there some sort of change made to the strike price to reflect the new value of the stock? A very common question. We hear this a lot whenever there's, let's say, some sort of special dividend declared. Wow, this $15 stock is paying a $4 dividend. If I run in and buy that 15 put right now, I'm making $4. Doesn't really work that way, does it, Mr. Kavanaugh?
It does not. It would be a great thing if it did, because we understand how to buy puts. You'd have some significant earnings right away. Before I go into the special dividend announcement, the thing that happens is the dividend's priced into the put. A standard dividend is priced into the put. That's part of the pricing. It's priced into the put. It's factored into it as you go along. When a special dividend is announced, our friends with Eric's company, the OCC, make a special announcement of how the non-standard options are now adjusted to reflect that special dividend announcement. So unfortunately, if a stock is trading at 20 and they announce a special $5 dividend and you're long the 20 put, the premium of the put, or the strike of the put, I'm sorry, it's subjective. It's case to case. If you go to the OCC.com and you type in the symbol of the stock that you're looking at in the search bar, it'll show you how that's adjusted. But it typically is just a strike adjustment for a special dividend. The most recent case I can remember was Options Express declared like a $4.50 dividend in January of 2010. Microsoft did one probably back in April or March of 2005. That was a pretty substantial special dividend that I can remember getting a lot of calls. I'm sure anybody that manages a trade desk at any of the big option trading firms like a Thinkorswim and Options Express and Interactive Brokers is on those special dividends fielding a ton of calls with a bunch of confused callers. So you can read up on the special dividend and how it's handled at the OCC website. Or, if interested, I can provide some information of experiences I've had with that as well.
All right, great question, great answer, Mr. Kavanaugh. Next up, we have another question. Seems like everyone's got dividends on the brains this episode. A question from the Newt. I like that handle. He writes, if I own a call on a stock and it declares a special dividend, do I collect the dividend? Mr. Eric from the land of OIC, why don't you walk our listeners through the magic that is calls and dividends?
And I think that Mike touched on that, Mark, and I know that it is a concern of a lot of investors out there, in terms of special dividends. And one of the things is, as a selfish plug, I'd like to provide out to your listeners is the 888 options number, because one of the things that we do provide, my investor services guys, is that if there's any concern about an ex-dividend date or something just doesn't look right when an investor is concerned about their particular contract, they can most certainly reach out to our group and go through the minutia of determining whether it's approaching their ex-dividend date, whether it just doesn't seem kosher.
A great service. We don't plug it enough here on this show. There actually are operators standing by right now, listeners, to take your options questions and answer them. So, yeah, hit those guys up over at 888 Options. They could walk you through a lot of these specific questions. And long story short, Mr. The Newt, if you own call options on a stock, you do not collect the dividends. So that's why we have these trades we've seen called dividend plays, where people go through these elaborate exercise routines in an attempt to game the system and to try to capture dividends when they do own the options, because they don't capture them outright. You have to exercise the option, collect the stock, and that goes through a whole bunch of other calculations of, is the value of the dividend greater than the remaining extrinsic value of that call option? If it is, then it's worthwhile to exercise. If it's not, then not. But that's pretty much why people go through those elaborate exercises in an attempt to determine whether the dividend is worth capturing, because long story short, you don't get the dividend if you just buy the option. So keep that in mind if you're buying an option on a stock that you think might declare a substantial dividend. Make sure if it's worthwhile, you have to exercise that call in order to capture that dividend. All right, and last up, we have a question that sounds tailor-made for you, Randy. It's a question from Mike Z, coming out of Tampa, Florida, and he falls into a category that I think a lot of listeners of this show do. We have a lot of advisors and asset managers listening to this show, but we also have a lot of people out there who are looking for advisors and asset managers, and they want to arm themselves before they go into that conversation with some options and knowledge. Mr. Mike Z sounds like he's in that same boat. He writes, I would like to gain some volatility exposure in my portfolio. Which volatility product should I recommend to my financial advisor at our next meeting? So, Randy, Mr. Mike Z is going to go meet his financial advisor, and he wants to add some the kick of vol to his portfolio. What advice do you have for him, sir?
Well, I guess the first advice is I'd make sure that his financial advisor really knows how to use options properly. And assuming he does, I think you would have to say there's a direct approach and maybe an indirect approach. The direct approach is, hey, if you want to get some volatility exposure, maybe you want to use one of the volatility options like the VIX or something like that to get some exposure, whether you want short or long exposure. Obviously, every option has a volatility component so if you wanted to gain some volatility exposure by buying a straddle or buying a strangle, or if you did not you wanted to short the volatility, then you could obviously sell either one of those. So I think it just depends on what level you want in terms of the exposure, but I would always start off with the VIX.
That's a great point. I think a lot of people overlook the fact that so many options are volatility products in and of themselves. They think they have to go buy a VIX option or perhaps a VIX future or VXX or whatever the case may be to get that volatility exposure, when the truth is everything we've talked about on this show and all the other episodes of the Advisor's Option all provide some measure of volatility exposure, whether it's long or short, because options have that volatility component to them. So if you have a portfolio and you buy a put to hedge that portfolio, you are adding volatility exposure. You are adding a volatility component to your portfolio. So you don't have to go the elaborate route of really studying up on the VIX and learning about the VIX and how it works and adding the VIX to your portfolio, or perhaps overwhelming your advisor with that sort of information. A simple put, covered calls, all the things we talked about all have volatility components to them. It depends which way you want to go, long or short, and how much volatility you want to add. But if the easiest way to go is simply just to add individual options to your portfolio and perhaps go from there. It might be easiest for you to understand, might be the easiest way to present it to your financial advisor, and the two of you can build your exposure and kind of grow together as it suits your portfolio. So great question, Mr. Mike Z. Great questions from everybody this week. We love your questions here at the Advisors Option, so keep sending them in. You, of course, can reach us at theoptionsinsider.com. You can, of course, leave a comment on the show notes for this particular episode, and we will route it for the next episode and get it ready for that episode. Or you can find us on Twitter, twitter.com/options. Find us on Facebook, facebook.com/theoptionsinsider, or reach us the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put question for the Advisor's Option in the subject line of your email so we know which show to route your question to. So a lot of great ways for you to join your fellow listeners and make your voices heard on the Advisor's Option. And now we're going to keep on rolling right on into our final segment, the Industry Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, listeners, this is our final segment. This is the buzz. This is, of course, where we inform you about some interesting upcoming developments or trends in the world of options that you may not be aware of, but that can certainly impact you and your practice. And this time around, we're going to focus on some interesting events that are coming up that may interest you, the active financial advisor or asset manager or even financial planner who are looking to add options into your practice. And the first one I'm going to mention here, before I toss it over to Mr. Eric, is it's an event aimed at financial planners actually in the Chicago area. So if you're in the Midwest, particularly around Chicago, this one should interest you. And it's the Financial Planning Association of Illinois Fall Forum. And it has a bunch of different things that are aimed at financial planners, talking about insurance, annuities, all the things you may be interested in. But the reason I really recommend it for you, because it's being put on by a friend of mine who really is very well versed in the realm of options. He's a former market maker, so there will be an options component to it. And of course, you can always seek him out at the event. He is the planner of the actual event. His name is Bill Ulivari. He does a great covered call service. He manages a small RIA now. He could certainly walk you through some of the finer points of income generation and trading using options. So I wanted to point this event out for you because it is so interesting for a lot of the advisors. I know a lot of you listening are in the Chicago area, so this may be interesting for you. It is on September 19th out there in Oak Brook, Illinois. You can find out more at fpaillinois.org. You can see the whole agenda there, what they're going to talk about, meet some of your fellow financial advisors, and maybe you bump into Bill and you can ask him some great questions about options and how to incorporate them into your practice. He's a great one to ask because he's actually out there doing it, and he works with a lot of you financial planners and advisors in a lot of different capacities. Now, I know, Eric, you have a great event coming up over there at the SIBO that a lot of our listeners may be interested in.
Yeah, absolutely, Mark, and thank you. I think this program was absolutely timely, most certainly for advisors that are worried about where the markets are going. So clearly, one of the things that we're finding out in the field is that more and more advisors are looking to employ spread strategies within their portfolios. You mentioned Bill, and I'm glad you did because he's a good colleague of ours at the OIC. We actually are involved with FPA Illinois. It's one of the largest chapters in the country, and we're actually working with Bill because the OIC, along with one of our exchange partners, that's the CBOE, is going to be hosting a forum which we call the LaSalle Street Wealth Advisor Forum, and that's going to be a one-day event held at the CBOE. Not only will this be celebrating the 40th anniversary of the first listed option, which happened at the Chicago Board of Options, but also will be celebrating my employer, the OCC, the Options Clearing Corporation. But this, Mark, is a free event. It's on the heels of what we did in New Orleans last year. It will be wealth advisors from around the country, probably a concentration of Midwest advisors. We have the agenda up on the landing page, which you can find at the CBOE website. And we're excited. It will be a high-level event, which we've done in the past, but it'll also be an opportunity for other advisors to kind of exchange ideas and also learn about different ways that advisors are using options with clients.
So that's going to be on October 15th over there at the SIBO. The registration URL is a bit long, so bear with me, listeners. It's go to sibo.com/learncenter, CENTER, /WA/ waagenda.aspx. So that, I'm sure, is the Wealth Advisor /WA. So maybe if you just go to cbo.com/learncenter/WA, that'll probably take you to a lot of the information about that event. So if you're going to be in Illinois on October 15th, I encourage you to head on over there and check that out as well. You guys did a great event, Eric, back in New Orleans a couple of years ago. I'm great to see that you're keeping that spirit alive and having another Wealth Advisor event here in Chicago. So listeners, be sure to check that one out. And now that's unfortunately all the time we have for this episode of The Advisor's Option. But before we go, I'd like to check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, Mr. Kavanaugh, what is cooking over there in the land of RCM?
We will be out on the speaking circuit in September. We're hosting a conference panel on the futures side of the business and the futures option side of the business, where we've got a couple money managers that will be hosting a panel and Ask the Experts panel in the interest rate and energy markets on the commodity side of the business, managed futures. So that's coming up in October. And then I'll be speaking at the options industry, or the Options Institute at the CBO, to groups of advisors to discuss hedging volatility in equity portfolios in special concentrated, I call them special circumstances, hedging highly concentrated stock positions using options. So if anybody's interested, I can get the info out on that as well.
All right, sir. And if they want to contact you to learn more about these things, how would they do it?
mkavanaugh@rcmfs.com. If I'm on your speed dial, just hit 1.
All right, thank you for that. And Eric, we just hit on the upcoming Wealth Advisor Summit you're going to have over there at the CBO. If listeners want to learn more about the other initiatives that you have coming up over there at the OIC, where should they go?
Thank you, Mark. They can go to optionseducation.org. We'll be presenting down at the FPA National Conference in October. We'll also be presenting at the Schwab Conference in November. And I'm hoping that your next program, you'll be able to get Randy and Mike back to talk about the Godzilla-Mothra trade, because I've heard a lot about that spread trade, which is quite unusual, and I really want to hear more about that.
That is a very, very profitable trade. I know all of us here have made and lost quite a bit on that particular spread. So perhaps that would be a worthy episode to explore in the future. Thank you for that, Eric. And last but certainly not least, Mr. Randy, what is cooking out there in the land of Swan Wealth Advisors? Do you have any appearances coming up? What do you want to let our listeners know about before our next episode?
Well, we're going to be at the Alternative Conference in Chicago on September 23rd and 4th. We also have a couple conferences with the Carson Institutional, one in Philadelphia on September 13th, and then in Omaha, I think in October 2nd, 3rd, and 4th. We're also in the process of getting our final compliance checks on our most recent version of the Good, Bad, and the Ugly. That should be out on our website within the next couple weeks. I always have any interested people would like to go to our website and check out all our upcoming events that we list out there, and as well as recent publications.
And that website, of course, is swanwealthadvisors.com. I'm looking at it right now, Randy, and it's been nicely redesigned. Looks great. Surf on over to swanwealthadvisors.com if you want to learn more about any of Randy's upcoming appearances, or, of course, all of the mutual funds and the other things they have going on over there at Swan Wealth Advisors. And they have his contact info right there at the top of the site, so you can reach out to them a number of different ways and find out more about what you guys at Swan have cooking. And on behalf of Randy and Mike and Eric and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, making it such a success. And I know I hear your pleas. We're looking to get more episodes out because I know you guys want so many more episodes of this program. We're working on it. We hope to get you more episodes sometime soon. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.